freedom isn't the result of wealth. It's the foundation. Welcome to Wealth Independence, where freedom leads and real wealth follows through battle-tested strategies, hard-won lessons, and real-world experience. You'll discover how to accelerate your path to true financial independence. And now your hosts, Dustin Bailey and Adam Penn.
All right, welcome back to the Wealth Independence Podcast, where freedom leads and real wealth follows. I'm Dustin Bailey, and I'm here with Adam Penn. Hi, Adam. How are you? How you doing today?
Doing good. I had a nitro cold brew and a almond croissant or almond bear claw, which was just delicious for breakfast.
Does the bear claw enhance the nitro?
It's a really good balance because the nitro is like fairly bitter, right? I mean, It's smooth, but it's bitter, and then the bear claw is a little too sweet for me, so they balance out.
Every time I hear someone, or I hear of bear claw, I think about the Weird Al Yankovic song "Albuquerque," which
not familiar.
Okay, well, I'm a big Weird Al fan, so that's finally out here on the podcast. Where it's about a 10-minute long song, and there's a lot of different scenes in the song, and one is where he's talking to a guy in a bakery and asks if he has any bear claws, and anyway, so every time I hear bear claws, I hear that line of that song. So that's neither here nor there. I'm sure
no one's listening to the episode anymore.
That's right; they've all tuned off, which is quite unfortunate because I think we've got a really good episode coming up here. We've got an interview.
Yeah, we're interviewing Ian today. Very successful, very involved in mobile home parks. Right now, he's involved in mobile home parks. He started with a family business in dry cleaning and had 14 locations, 90 employees, sold it, and really, I think he aligns a lot with the way that we do investing. And so I think it's interesting to hear his take on things. We're not like really close friends, so it's not like we've come up in the same group or learned how to structure deals together. And I think we have a fairly aligned viewpoint. So it'll be exciting to hear from him and hear some of his perspectives.
Yeah, for sure. Well, let's dive straight into it.
Ian, wonderful to have you here. Wanted to learn a little bit more about you and kind of your journey from business owner to passive investor, and now you do some deals yourself. So do you want to start off by just telling the listeners a little bit about yourself?
Sure. Yeah. Thank you for having me. I live in Austin, grew up here, and got into a family business. It was a dry cleaning company, and spent the last 14 years doing that, and then started investing in real estate along the way. So this is 2014. I bought my first rental, started buying single family rentals while I was running the business just to get something going on the side. Then kind of went into the commercial and space with triple net leases. And I still actively do that today, but my focus after selling the company in 2023, the focus has since been on passive investing, first out of a personal necessity for some tax benefits after selling the business. And then now, I focus on just helping other people get involved in real estate. Come to find out, a lot of people don't know that they can do it, and they think that it's only for the elite. So I like getting, Main Street America involved and sharing, what it brings in terms of freedom, wealth building, et cetera.
So, maybe to dive right in, you had a big business, right? It was a family business, but was it 14 locations?
It's 14 stores, yeah.
So 14 stores, and you sold this off to like private equity?
No, we were in a strange position to where private equity wasn't too involved in the dry cleaning space. And so I actually found an individual that he came from an M&A background. And so he structured it like a private equity deal on the back end, but no, just ended up selling to an individual that had some investors, and it worked out really well. So that was, again, a couple of years back. And get this, he retained all of the key employees, which is so amazing for a company that size. Wow. Granted, we didn't have many, each store has a manager, but in terms of, back office stuff, everybody stuck around. So a testament to how good of a transaction that was and how great of a takeover he did.
That's great. So one thing in kind of the, we're the Wealth Independence podcast, one of our focuses is on freedom. And so there must have been this like huge weight off your back or shift. Kind of what did that look like to you? And obviously you've chosen to go in this new direction. what did you want to focus on around, time freedom, your ability to kind of have your own control after having this large exit? Because you're not just in the business of building a business to sell it.
I didn't really, honestly, the day after the transaction or day of, I didn't really know what to do. And my interpretation of what freedom would be was, I thought I was going to go take a couple years off, go travel around. So my wife and I, we take our kids and we travel a lot. And what was hard about that was, number one, I did have the freedom to wake up and not have to go anywhere. So that was a huge, lift. But I also found it, I struggled right afterwards with an identity of, I was this, for so many years, I was this person, and I never called myself a real estate person, even though it was like the one thing that I love to do. I mean, I spent all my free time, not building rentals, right? Like acquiring more rentals and so, yeah, freedom was the ability to not have to get up and go to work and, kind of have more time for my kids. It was the perfect mix. Like my children I've got 3 kids, as of today, they're 5 and under. So for me, getting that time back with them, I know it goes fast. And so I was fortunate to, right now I'm very dedicated to giving as much time as I can to them.
That's great. So from having that freedom, right, and having all that experience of running a business, where, and now you primarily just do investing and operate investments for other people, what's primary skills do you feel like transferred over the most from being a business owner, right? Because most people do this going from a W-2 employee to being an investor. Not a whole lot of people have that experience of being a business owner. So what do you think gave you an edge as an investor coming from being a business owner?
I think, first things first, I was already in real estate and on the active side. And so that just helped give me a general understanding of how everything works. But from the business side, looking at a basic P&L, I was used to a low margin business. And so there were certain expectations where if somebody in, let's say the tech world was to review something and they were used to maybe how valuations worked in the tech world, as a small business owner, everything, in my opinion, was a bit more grounded. And I was able to look at things through the lens of, okay, does this fit my risk profile? Does it seem appropriate for what they're doing? And then, I kind of landed on mobile home parks. I wasn't, mobile home parks was that answer for me. And so got in, and how I got into this business was, again, out of personal necessity. So I found some passive investing groups that I was, comfortable with. And I'll say that for anybody, listening, the hardest thing when you get into, the world of passive investing is you have a lot of confidence in yourself, in your profession or trade, but you're having to trust somebody with, who has the right interest and to take care of, be a good steward of your capital. That was the hardest thing for me as an entrepreneur. I was used to calling the shots and running the show. And then I had to hand that over to somebody that was trusted. So I've learned a lot along the way. I've lost along the way. This was prior to me getting into the business, just as a passive investor. I've had a hiccup already, and that helped me kind of build out how I wanted to structure the company. So lots of lessons learned from that. And, but mainly back to your question, it was knowing a P&L. I'm a low risk guy. So that's the sort of opportunities that I look for personally.
It is, it's amazing how many investors or people we talk to, or even owners. I own a short-term rental management company as well, and we manage Airbnbs, and I'll send P&Ls and balance sheets to owners, and they're like, they don't have a clue what it is. They get confused. Like, why is this on a balance sheet and this is a P&L? So, I mean, just having that edge alone kind of puts you a step ahead of some people who it's just not taught in everyday education. So you have invested in other people's deals, and I would love to talk more about the deals you do. But first, what is something that you look for in due diligence of these other deals that you think maybe you either see investors skipping, to our point of not understanding a P&L, but what's something that you always look for that you maybe think other people don't?
My criteria has changed. I'll tell you that. I think I was much more loose when it was just me. And, number one, it started with the people that were involved. So my number one suggestion is if you don't get a good read on a person, or if your gut tells them, I don't like that person, don't invest with them. There's a lot of people out there and a lot of opportunity to be with somebody that you know, like, and trust, and then feel that they're going to be the right person. So number one, it comes down to the people. Y'all know this because you're in the business, but for those listening, it's so many projections and pro formas will tell you exactly how they think a deal is going to perform. And they use all these metrics and returns. And at the end of the day, real estate is a people business. It does come down to people running it. Although, passive investing is fun, it's very active on the back end. There's a team that's running it. And so, your job is to ask the right questions. And now I try to advocate for people that, we co-invest as a group in all these deals. And so, again, I'm looking at it through the lens of, do I like this for myself personally? And then if it passes all those tests, bring it to the network. But I'm looking at, is this person in any lawsuits? Can I find any bad dirt on them on the internet? Like what's their communication style? So I'll Google the words scam, fraud, Ponzi, next to their name, like dig the internet because it exists. If they've, if people are bad actors, then you'll probably find it on the internet. So definitely do that. Ask them about their failures. A lot of people are, proud to tell you how they've succeeded in a lot of ways. And, you guys know there's been good runs and rough runs over the last couple of years in the investment space. And, so, I do want to know that people have failed and how, somebody that kind of brushes that off, again, red flag for me. So I start there before, and I won't dive too further into like the underwriting side, because I think people is the first hurdle that, they got to pass the people test first before, you even looking at the numbers.
We have a mentor that says, that the team matters first, and then it's the deal, and then it's the market. If you have a horrible market and a horrible deal, but you have an amazing team, you might make it out okay. But if you have a horrible team and a great deal in a horrible market, or in a great market, the team's not going to be able to execute. So, very important to have good people on the team. One more thing, kind of just on the evaluating deals and ones that either you've invested in or things that you kind of walk people through now. What's something that, coming out of your business experience and going into being a professional investor, what's something that you look for now that you didn't even know mattered when you first started?
So rewinding the clock to when I was first an investor in, single family rentals, that was napkin math, right? Like you knew how much rent cost, how much you'd get in rent and what the mortgage was. And so I'd say for people on the sidelines, if that's an option for you, it's way less complex than you think. Although the sophisticated ones have this dialed down to where it's to where it's very robust underwriting. Now, the thing that I didn't know about before getting into the business was in these underwriting models today, they're highly complex, and they'll have, you'll have cap rate tables, sensitivity analysis, vacancy rates, and all sorts of projections that are built into what, you then think will be the outcome. And so a lot of them, and this is just a simple statement, but a lot of people, when they see the projections, they think like, hey, it said 9% or 10% on paper. Like that's what I'm getting. So that's one, misconception that people need to be aware of. I've also learned too, from the marketing side, a lot of passive investors are marketed to, to maybe earn the investment dollars for, tax purposes, like tax write-offs that they can take advantage of. So, for the common, let's say tech employee, some of those benefits, yes, there's still great benefits to investing that you may not get elsewhere, but it's not like you can just say, I just got a K1 loss for $100,000 and I'm going to wipe that off my salary from Amazon. So I think that the marketing does a really good job of like making people click and say that, but it's everyone's job to educate people that, you might not be able to do that depending on your circumstance. So lots of little things. And then I think I was just afraid to ask when I first got started. I was afraid to ask more questions. So now, ask away. You guys, there's hundreds of questions that you can ask in terms of like contingencies or what ifs. I tend to stay away from, again, the higher return deals only because, with higher return comes higher risk, and it just doesn't fit how I invest personally. But I think in the beginning, when I was just an LP and I was talking to somebody, whether they were in a suit or a large company or whatever, I think I was just like, I'm supposed to trust this person, right? And you learn really quickly that, they're just like you. And, you guys are basically going into partnership, and hopefully that everyone's interests are aligned. And so I'm not afraid, to ask those questions anymore. And I think when I first got started, wasn't really certain like which questions you're supposed to ask. So a lot of what I try to do now is just educate people, what should you ask? And again, it's not rocket science stuff, right? Like it's just things that the person you're about to give your money to should be able to answer and not be irritated, and just guide you through the process. That's how it should be.
Yeah, if a sponsor gets irritated when you ask questions, imagine what will happen when something goes wrong.
Yeah.
So right now, a lot of your focus is on mobile home parks and private lending, if I'm not mistaken. What, on your current investment thesis, what makes those compelling to you right now?
I look at it from two positions. On the private lending side, it's the particular investment that I first got into, and then formed a business partnership with, and what we have now. It's liquid, it's consistent returns. We've got a good track record of 5+ years of no missed payments, no pauses, no distributions. So I use that for my my steady cash flow piece, and then or I'll call it like a parking garage, essentially. So I like to have the debt side to invest in, and then also the equity side where I know, okay, money's going to be tied up a little bit longer. Mobile homes specifically, and why I was drawn to them. Number one, there's an affordable housing crisis. I think that they got a bad reputation. Not really. In the investment world, they do not have a bad reputation, but like from the outside looking in, people will say, what are you doing with trailer parks? Like, why? I'm not going to be a slumlord. There's a lot of misconceptions on that, but there's slum style apartments, there's slum houses. Like, it just depends on, again, like what that property can bring and who is running it. By the way, some of the mobile home communities, they call them manufactured housing communities now, but people will still refer to them as mobile home parks, are beautiful. Paved roads, sidewalks, community centers. You've got some really nice ones that exist out there that people just wouldn't even think, they wouldn't even call it a mobile home park. But I like the affordability aspect of it. So you can compare, rents to a 2-bedroom apartment and say, all right, well, if that's $1,200 for a 2-bedroom apartment and lot rent that, that you're paying each month is $600, there's a big difference for it being affordable. I like that tenants stay on average 14 years. That is a huge thing. I'm used to like turnover like crazy, and my single family projects that I still have, and like how I first got into the business. So that's another thing I like. And then also the supply cap. And, a lot of cities don't want you to build a mobile home park. And so where there may not be as many objections to other, property types. So every single, as a real estate investor, like I think that all sorts of asset classes are good. You just have to find the one that you like and that you understand. And that's where I fell in love with that. I was like, it's supply restricted. That's cool. So those are some of the core things that drew me to it.
So you're going out, and obviously you've invested in deals passively. Now you're putting deals together yourself. There's all sorts of ways you can structure deals, right? And I think I've seen quite a few. Me and Dustin we're basically every deal we do is an 80-20 split with some type of small origination fee up front. And that's normally about the only fees we do, or the only way we really make money. We don't add a crazy waterfall. We don't do a preferred return. We don't add, turn the light switch on and off fee or anything like that. So what do you see how people structure deals? And I mean, I'll add the caveat. We also have a debt fund that has a pref on it. But outside of that, that makes sense when you're equating it to a note in my mind. But so how do you feel about different deal structures, and what have you seen out there that makes LPs more comfortable, or you think benefits them?
So number one, 80-20 splits are good. And I think that I've seen less of those lately. Sometimes there's, operators are wanting bigger check sizes to get that 80-20 split. So I think over the last few years, I've seen a lot of complex ways to structure it that I think are confusing for the average passive investor. When you talk about, profit splits, most of them get like preferred returns and profit split. But when you start to hit like hurdles, waterfalls, IRR metrics, and things that are like performance based, I understand exactly why when people run them that, that they put them in there. People running the actual deal itself want to be compensated well for their work. But I do like the simplicity of saying like, this is what this is what we're going to be throughout this deal. And then, just looking at, are they going to, is this a group or unit that, that feels they will sell this property or refinance this property? I think that's another thing that a lot of people may not ask. Like a lot of past investors just think, well, let's just sit and see what happens. But it is nice knowing somebody's strategy of, this operator will refinance in 4 years or 3 years and hope to give a return of capital. So outside the business realm, just as, if I'm putting my investor hat on, I like that personally. Like I can get some money back or get my initial capital back on the refi, take my risk out of it, go do it again, not have it be a taxable event. Yep. So there's so many things that depending on your situation that you can look for. But a lot of people, again, don't know. So your simple structure is good. And I think it benefits everybody involved because they're not worried about, it just is what it is. And I think a lot of businesses are structured that way. So I like seeing real estate structured that way as well.
That's a good point, right? When you look at partnerships in business, it's not normally like, hey, if the business grosses this much this year, I get some type, sometimes on a PE buyout, you get an earnout or something, but it's far and few between compared to just a regular partnership.
Partnership, yeah.
So you touched on it a little bit earlier, but how do you think about tax strategy when you're looking at deals or comparing different deals?
I think that, when you look at how the wealthy invest, people might say, okay, the average person may say, what am I going to invest in? Single family homes, multifamily, commercial. So there's I consider tax strategy a class of itself. Like sometimes people are motivated by not the potential earnings of the future, but what it can save them today. So one of the things that's kind of eye-opening in the real estate world is when you invest into real estate, and again, depending on your tax or how you file with the IRS, specifically like if people have real estate professional status, amazing opportunity to keep your wealth. So it's the core of every deal. I like to tell people what the tax benefits will be. I like to explain what depreciation is, what a paper loss on their K-1 will look like. Little things that may, from somebody that may be coming from a W-2 job and they see a piece of paper with a negative sign on it, they might think that's not good. But really just kind of shifting the mindset of saying, hey, there's so much opportunity for you to, either offset it against your ordinary income, depending on your family status, or, offset future gains. And I think real estate really opens the door for people to, when you see something like that, you don't unsee it. It's not like if you were to say, hey, Dustin and Adam, I can sell you this at $100, or I can sell you the same product at $50. You're going to want the better deal. And so I think it comes from a tax strategy too. I know these people, I got to pay this much to the IRS. It's there might've been a better way. And it's fun helping people. I'm not a CPA, right? So I'm not able to advise, but I can at least share my opinion. I'm not afraid to do that.
So you once again, you've kind of touched on this, but you talked a little bit about, hey, you've got a deal, understanding what the sponsor's plan is, right? Is it going to be a cash out? Is it going to be a sale? And then on that side of things, people put metrics with that, right? And we've had investors ask us, hey, how does the IRR of your deal compare to this other thing? Or what does this look like in a 5-year time frame? And those IRRs kind of get skewed a little bit on kind of that infinite return model where you're just doing a cash out refinance. So what are maybe some of the misunderstood metrics or some of the metrics that you look for when you're going in and either putting together a deal or investing in a deal?
The fact that you said that the IRR gets misconstrued, or sometimes you're not comparing apples to apples, is important, because yes, if you're looking at a deal that plans to sell at year 5 versus a deal that maybe it's an infinite hold and they want to refinance at year 5, sometimes it can be tricky to really know one looks better than the other. So I would say that's an important thing to align with. Do you want your money? It's not that it's going to be, I guess in either, in either scenario, that it wouldn't be tied up forever. It's just one of them, hopefully when you get your money back on the sale, you're going to have a taxable event, and the other one you will not. So I think that a lot of it just comes down to what's your specific situation? Why do you want that? And to your question of the metrics and numbers, yeah, because you're averaging, let's say if you're looking at, year 1 through 5, and then it's going to be a sale at year 5, you might look at your return differently versus if it's stretched out over 10 years, you may have a lower cash flow average. Well, the reason you have a lower cash flow average is you're going to get more, year 1, 2, 3, 4 or whatever until the refinance. But then after that refinance, your cash flow drops because you got your initial capital out, a loan was taken to be able to pay that back, your preferred return or however the deal was structured was given to you. And now it's like you have no skin in the game. Let's pretend you own 1% of that deal. Well, now you're going to get your cash flow profit split of 1% for the life of that deal. But if you look on paper, years 6, 7, 8, 9, 10, and it shows you got 1% cash flow, 2% cash flow. That doesn't move the needle for a lot of people, but it's really understanding like, well, no, you're about to get, you got all your risk out of it. You're an owner. You can go do it again quicker with another deal. And now you get the upside of the potential sale in the future. There's a benefit to that. And so I think just like laying that out, because I've had people ask me, why does cash flow suck year 6, 7, 8? And again, it's like, we're going to refi. This is what that is, because you all know, we talk about this every day, but for a lot of people, it's like, why would you need to refinance? That's taking out another loan. Like many people just don't know. And so it's our job to educate. Yeah.
It is a mindset shift. Definitely. Well, kind of one of the last questions I have is just going from, I'm sure you were very busy with your business, the laundry business, and you got 3 kids. What does your life, work balance, freedom look like to you? And how do you see passive investors kind of gaining some of that freedom by participating in these deals that can honestly be life-changing?
Yeah, in my personal experience, the freedom that came from it is, number one, without the business, I'm not getting 2 a.m. phone calls. I'm not having employees quit. I'm, not working shifts and driving, being a delivery driver for the day, all part of the necessity of having a small business. But, the freedom that comes with it, again, I mentioned earlier about the ability to have time with my kids. I was ready to go in and buy another business right off the bat. And then I had to take a step back and look at like, okay, I have a very special opportunity from, 15 years of hard work, and I was compensated for it. Now, how can I make the best to where like I can still earn a living or, have this passive residual income that's outside of me, that doesn't force me to just get on the clock and work. It's that whole like not trading your hours for, your time for money. So now, the freedom is I'm involved in a lot of passive investments, and this is outside my own, business and what I offer today. I think there's, I'm not just like, I don't just keep it all in house. There's good operators, there's good opportunities. And there's something really cool about, first of the quarter or when the quarter ends and then getting distributions via an email, like you got ACH. And I've done enough of them now to where all of a sudden you can get, I don't know, on any given day, you can get 4, 5, 6, 7 email, and then, so I don't think one passive investment deal changes your life, but the freedom that can come from the mindset shift of I'm going to get started with one. And then in a couple of years, like each year, then you just start simple, maybe try one a year. If you do that each year for 5 years, next thing there's a revolving door of you getting back that money. And then it opens up the opportunity for, I said mailbox money the other day to somebody, and they're like, no, not anymore. It's ACH money. It doesn't come in the mail anymore. So ACH money is cool.
Doesn't have the same ring or visual appeal to it, does it? Like, there's more digits in my bank account today.
Put it in the mailbox.
Yeah, exactly.
Yeah.
No, I think that's so good because like we talk about that often, especially in the context of, as we were kind of talking around this earlier about the idea of infinite returns, right? And being able to like get that money back. And to your point earlier, people are like, well, why would I want to refinance? Well, it's like, okay, you get that money back and you still own this deal. Now you go redeploy that elsewhere and it starts to get that compounding. And I love what you just said there about it's not like one investment that makes it, but when you start stacking these things, man, it gets powerful, and it gets powerful in a hurry. And then all of a sudden you're in that situation where you're getting those 4 or 5 emails a day that money's just hit your account. And that's a pretty awesome place to be.
Yeah, it's really cool. And again, one day speaking to you said some of the audience is tech based, or for whatever you do today, if you're a business owner or you're a W-2 employee, there's things that can happen. And y'all are seeing it right now with these layoffs. This year, it's hitting the news, and I feel, that's scary. You imagine like busting your butt, and then you wake up on a Tuesday, and it's like, see ya. And that's a real life thing. Unless you work for yourself, that is a risk that you are taking. And so I tell people all the time, like, you just never know when that day comes, and you have the ability to take action now, to actively choose to put your money in a place to where you're going to grow wealth outside of your career, because you never know. And everybody faces it. Like, you could have a disability or a death in the family or whatever, especially if like you're a business owner and the business runs on you. So that could, you might have visions one day for your retirement of being able to sell your business for a certain multiple, and then it all comes crashing down because you got cancer. Like, I know it sounds, it's really dark right now, but like these things do happen. Yeah. Oh. These things happen. And so, this isn't some fear tactic. It's like, no, this is real life, and you can make moves today. And what's funny too is like, in the real estate space, people talk about like interest rates. Interest rates aren't good right now, so maybe we wait. And then obviously you guys know a good answer for that. But like, that's not an excuse either, because 10 years ago or 20 years ago, or when interest rates were up in the teens, like, people still bought, things still appreciated, things still clicked. And so like, there's never an excuse. You don't want to be standing on the sidelines looking back saying, man, I wish I would have done that. So
we do, and not to pick on any one person, but we do oil and gas investing. And someone the other day, who I don't think listens to this podcast, is like, I don't think now is a good time because the rig count is down nationally. And I'm like, I don't know that the national rig count on oil rigs is a super good indicator for this one deal, but it's something, right? So, just to your same point, interest rates are high. Okay, well, relative to what?
Yeah, there's always going to be a risk factor. And it's a difficult sell too, because the market has done so well for so long. Like, you guys are young guys. And so in your investment career, let's say you probably didn't have a ton of money in the market in 2008 and 9, right? Like, a lot of us were just starting off, and, you only know the good so far. Yeah, there was a big dip in 21 or 2, and then it rebounded the next year. So it was like, it was like a fast reset. And so, yeah, it's hard, trying to educate and say like, hey, you do need to balance and diversify yourself, because, those 20% returns aren't going to be forever. But makes it tough for the low risk stuff. Like, I like a good 8% all day long, but, again, I get that it's a mindset shift of like, why would I do that? So I think that in time, again, you just never know. It's another diversification method. Do the market, do real estate, do whatever else makes you happy, because, you need to spread it out.
Well, ordinarily, I would ask the question we always ask about freedom, but I feel like Adam kind of asked the same question in two different ways. So I don't know, I don't know, Ian, if you've got any sort of different answer, but the question is, with the Wealth Independence podcast and independence and freedom and all that, and you've talked about having time and spending time with family and your kids, and I'm just curious, how when you think of those words, either independence or freedom, like what comes to mind, and sort of how do you live that in your everyday life?
Number one, it was, comparing it to my past life and being able to get up on Wednesday and go for a run, and just take the time to where, that used to be me on the other end, looking out at all the people, at coffee shops midday, or, exercising or doing whatever, and thinking, do they work? Someone jokingly said earlier, that's called working from home. Now that's the movement of getting out and having fun. But yeah, the freedom for me is take vacations when I want to, but really it's the emotional stress. I was very emotionally trapped to what I was doing. I think even as a W-2 employee, people also feel that sometimes. So that they're always on call. They're always, they're always expected to be there and to answer. And so that is a big freedom that I have found through real estate investing, is that because I went, and focused on that, I don't have to worry about that to the same degree. So I've been having fun, and I know I don't get these years back with my kids. So this is, I'm pretty passionate about it.
Well, we really appreciate you being on the show. What's the best way for people to connect with you if they're looking to reach out?
Yeah, so I'll send something so you guys can include in the show notes. It'll be basically, you asked earlier about some questions that are good to ask. I have a little cheat sheet that I built that, for anyone curious in getting started, what are the questions they should be asking the person that they want to invest with. So it's a tool I wish I would have had when I did my first one and many years back. So I'll have that. You can also find me online at runsteadyinvestments.com. or on LinkedIn as well. I think that's probably the most active social network I'm on. So those are 3 places.
Excellent. Wonderful. Yeah, we'll include all that in the release notes below. Thank you so much, Ian.
Great. Thanks for having me, y'all.
All right. Well, that lived up to our expectations.
Yeah, I thought it was a great interview. I really enjoyed his viewpoints. I enjoyed talking to him. It's too bad we're not, we all live in such different places. He's closer to you than me, but it'd be nice if we could all go grab coffee or tour the deals and things of that nature.
I know it was funny. Like you were saying in the intro about how you thought like we were aligned, philosophically and things like that. And it was just it was interesting talking to him and seeing that. And especially since like, I don't think that we've come up through the same groups and been around the same thing. So it's kind of interesting just that there was a lot, he had his emphasis around cash flow. I thought one thing that he didn't use these words, but I thought it was interesting talking about how he likes the debt for the cash flow side of it and the steady. How many times have we talked about a steady 8% before? Like we've told that to investors, like those exact words. So he likes that, but then also likes the mobile home parks to give kind of the equity upside. We talk so often about
and the cash out refinance.
Exactly. And yeah, the tax and everything or tax advantages. And like that, being able to put those 2 things together is like the exact stuff that we talk about often. So I feel like he's been listening to our podcast, but maybe he's been a closet listener, but it was interesting. There's just so much there that I found myself going, yeah, exactly. So very, very aligned on the viewpoint that I think you and I have for a lot of things.
Yeah, that was great. I hope everyone enjoyed it.
And, if you did enjoy it, certainly go and, do all the things that we always say to do. Go like it if you're watching on YouTube. Give us a 5-star rating on Apple Podcasts and whatever it is that you do on Spotify. I don't know what goes on over there. But we would appreciate it. Let the computers know you're enjoying what you're hearing here and can get more of this. We'll get more guests like Ian. But we appreciate everybody listening as always. And we'll catch you on the next episode. Just remember, where freedom leads, real wealth follows. Thanks, y'all.
Thanks for joining us on Wealth Independence. This show is for informational purposes only and is not financial, investment, legal, or tax advice and does not constitute an offer to buy or sell securities. All investments carry risk, and investors should always conduct thorough due diligence and consult with qualified professionals before investing. Until next time, remember, freedom leads and real wealth follows.